And we do look at futures contracts. If you're going to trade those, read the risk disclosure document for futures and options. And with that, we'll put up the old heat map here and just see what's going on today. Overseas, German industrial output posted its steepest decline on record in April, plunging 17.9%. Of course, this is due to COVID. ING economist Carsten Bresky called it, quote, the worst month ever for the Eurozone's powerhouse, Germany.
And
However, the yeah, go ahead.
yeah, and they're also expecting a contraction to be for the overall year, 6.3%.
Yeah, that's right. And even that is based on an assumption that they follow through with their 130 billion euro fiscal stimulus package as well. We also had the latest Centix survey results. For those not familiar, this comes out weekly. Poll of 1,500 investors across the world, mostly institutions. And we're seeing a big divergence between the current conditions and what they see 6 months ahead. Obviously, current conditions are at a negative extreme, but 6 months ahead, they're pretty positive. When we've had that kind of divergence in the past, the economy, not necessarily the market, because the market is already ahead of this, but the economy basically has bottomed. The last time we had these types of numbers in this survey were in 2009 and 2012 when the market, when the economy did turn around. Let's see. Now we said 6.3% decline. You said, Nina, in the for Germany in the eurozone. The World Bank came out today too, and they say that the global output's going to go down 5.2% in 2020. They say that would make it one of the most four severe downturns in 150 years. The other ones were the Great Depression and the downturns following World War I and World War II. Now, the bank's estimate looks more pessimistic than what the IMF said in April. We covered that back then, but the difference they are attributing to the fact that they've got a clearer picture of the COVID fallout than the IMF had in April. Remember, though, the stock market is not the economy, and the stock market is forward-looking. Okay, speaking about oil, it's been all over the place. So there's good and bad news here, if you're a bull, I mean. So they did have their OPEC Plus meeting, that's OPEC members plus their allies, over the weekend, and they are going to keep to their 9.6 million daily cut until the end of next month, with Nigeria and Iraq making up for their backlog of reduction since they weren't on board. So they're going to have to, those ones are going to have to cut more to make their quota. Mexico, though, said they won't pursue cuts beyond June. And also Saudi Arabia. So oil was up in the 40s based on that, but then Saudi Arabia came out this morning and said that, they've been doing so they've kept with the quotas, but they've been doing voluntary deeper cuts. But they said this morning that those extra voluntary deeper cuts are just going to last for the rest of the month because they've already served their purpose. So that was slightly bearish. And I think, Nina, you had some data on what's going on with the shale producers based on what's going on with oil and some break-even rates.
Well, as oil was approaching $40, a lot of these shale companies were bringing these wells back online. And but the thing is, they're also assuming that demand is going to start, recovering as well throughout through the rest of this year. Now, the Federal Reserve Bank of Dallas, they did a survey, and they do this, of course, all the time, where they ask what these different companies, what their break-even levels are. And their break-even level right now, it's a range. It depends upon where they where they drill. Different parts of Texas, New Mexico, Oklahoma, for instance, they have different rates, and it's anywhere from $23 a barrel to 36 bucks. And so that's the range. So as you know, we get over 40 bucks, more and more shale companies were turning these taps back on.
Yeah, that's good. And maybe they're starting to make a little money. And I think we're seeing that as we were talking earlier a little bit about some of the companies in the Russell, those smaller drillers are doing a little bit better. There was no, let's see, overseas, just to keep you abreast there. European indices closed mostly on a lower note. The DAX, so that's Germany, declined 0.2%. The FTSE, that's the UK, was down 0.4%, and France was down 4%, and the Euro Stock 600 declined only
But
0.2%.
for the week, they had a great week. I
Oh
mean,
yeah,
Europe,
we're,
London was up 6.7% for the week. France, 10.7%. Germany up 10.9%. And then if you go to Asia, I mean, Japan up 4.5%, China up 2.8% for the week, Hong Kong 7.9%, and India 5.8%. Now our markets, you know, the Russell was the big outperformer last week, up 8.1%. I know we'll take a look at the major markets too in a second.
yeah, excellent. There was no domestic data of note, Nina, but I will point out that we talked about this in Trader Talk this morning. Stanley Druckenmiller,
Oh
famous
yeah,
hedge fund
saw
manager.
that.
Yeah, he was interviewed on CNBC, and he was humbled.
Yes.
He said his fund from the March lows is only up 3% versus a 40% return on the S&P from the bottom. He underestimated the Fed put, basically. The Fed is supporting here.
Right. A lot of Wall Street titans, you know, not just Stan Druckenmiller, there was David Tepper. They were like on the same day. That did make big news. You know, they were interviewed like on the same day.
Yeah, and then Jeffrey Gundlach, about a few hundred S&P points ago, said he went short the S&P. So not everybody's right all the time, except maybe you, Nina. So there you go.
No, I'm not. No, definitely not. But dumb money. I mean, the dumb money is looking a lot smarter, you know.
Yeah, and you have some data also from FactSet about the PE ratio going forward, and a few data on that. So if you could enlighten us there.
Right. So FactSet, well, we're still, I mean, there's always some companies out there reporting earnings, but we're at the very, very end of earnings season here. 98% of companies in the S&P 500 have reported earnings, and overall, the earnings decline has been 43.3% for this particular, actually, that's the estimated decline for the second quarter, I should say. It's 43.3%. But for the first, all right, so that's what that is. Now, the forward 12-month PE ratio for the S&P 500, based on Friday's information, is 22.1. And that's just a little bit higher because the previous week, that PE ratio was 22. So if anyone's out there, if they're looking for that ratio, it's now 22.1.
Yeah, and remember, it's kind of interesting too. That's based on earnings estimates, but a good portion of the S&P withdrew guidance, so it's kind of a shaky number though. But it is elevated. Of course, the market is certainly looking forward. All right, let us take a little bit of look at the commodity space here. We'll start with gold. So it was a little profit taking in there, and now I got to do something here to get this scale. There we go. So holding on by a fingertip to the area we've told you about, right in here, about 1675. That's kind of an area that it should hold if it's not going to start really going down, I think. But it sold off last week. I think that was due partially to the risk on rally that we had. And also interest rates ticked up, which is not the best situation for gold either. But at least you could say it probably held that support. Front contract here now is August. And let's look at the ETF also. You can see we're still range bound. And even on Friday, when we kind of went risk on the market with that big day of 800 points, gold did manage to hold support. The first test to get back into the middle of the range is taking out that 50-day moving average. But looks to me kind of range bound. Looks to me like the easy money on the long side is probably over with for a while. But it's not a negative chart either. It's kind of just range bound.
Right, and you could see that, gold really took off of those lows, when the virus,
Right.
the news about the virus really took hold of our, the market headlines.
Right. And silver, which had been outperforming, and we talked about the gold silver ratio having been kind of really extended. Let's take a look at silver. Failed to break out of the flag there, unfortunately. So its momentum is turning kind of sideways too. Key level on the ETF here is about 1570. So it looks, again, kind of like gold kind of getting a little bit now range bound. Although the optimist would say, well, we did make kind of a higher high and a higher low. But anyway. All right, again, kind of range bound there. Let's take a look at the mining stocks for both of those. Let's take a look at the gold miners. They did break support. However, if you think the move down has been overdone, it looks like it's trying to test and hold right now the 50-day moving average. So if you wanted to give it a shot on the long side, you can set your risk pretty well. Although you've got pretty big resistance up there at about 33 and a quarter, which was the neckline of the head and shoulders there that formed. If we broke the 50-day, if we couldn't hold it, then the measured move of the head and shoulders would come into play, which is 38 basically to 33, a little less than 5 points, which would put it at about 28, which is where I got this line down here. That would only come into play though if you did, I think, close below the 50-day moving average. So right now, that's the level to keep your eye on. Okay, let us go ahead and take a look at the silver miners. Kind of like silver, it tried to hold support there. It looks like it did. We had that kind of that hammer candlestick on Friday, and we managed to get back up above resistance. So again, kind of range bound now. Once again, I think the easy money on the mining stocks is probably over. Not to say it's negative though.
Lee, I get this question all the time on my sessions. Why are, these gold stocks or silver stocks, mining stocks, why are they fluctuating versus the actual or moving, inversely to what's going on with the future? And just keep in mind, these particular mining stocks, they might have a lot of debt. They're run by, they're not an actual commodity itself. They're a corporation. And so it depends upon the management. There's also labor issues that might be going on.
And I think some of those companies are going to try and
so you have
take
to
advantage
take
of this
that into
opportunity.
consideration. It
Do you think
doesn't
it's the
always
companies
move
that are
in
strong that are rushing to
with the actual commodity?
Excellent point, Nina. Okay, let's look at copper. Confirming the equity market move. Wow, first time above the 200-day moving average this year, basically. We've already taken out the 250 level, which a lot of people were looking at, and you can see why the 250 level was important. If we put a line in there, it was that area of support last time. Broken support should act as resistance, but it powered right through there. And it tried, it doesn't go through the first time. That's usual. Never or very rarely on a huge support level or resistance level does something go right through it the first time, but then at the fourth attempt it did it, and now we're above the 200. So you can't say that you're getting a negative confirmation from the copper market on the equity market. And let's take a look at the copper miners. Even better. I think traders, if you wanted to play a bounce in here, you put a stop under the low on Friday.
And I know I've talked about this before, but you know, copper content when it comes to type of vehicle, it's quite substantial. If you're looking at a regular internal combustion engine, there's about 48 pounds of copper in it. A hybrid electric vehicle has 88 pounds, and a battery electric vehicle has 183 pounds of copper in it.
Wow.
You know, along with copper is used in, you know, solar, it's used in, you know, solar panels, and also wind farms. You know, wind farms use a lot of copper as well. And, you know, that's picking up, especially in China. They're using a lot more solar and wind farms out there.
Yeah, good point. Good point. Let's see. Someone wants to see the M2 money supply. Yeah, we've been following that. Let's take a look at it today. Huh? No surprise that that's happening. There's a lot of money out there, and that's one of the reasons the market's been going up. The only other time it shot up with this type of velocity is if we go back in here. You can see right after the financial crisis, right in there, right? You can see it's kind of the same rate of reset. So that happened over a longer period of time than this, though. So this is fueling a lot of money going into assets. It is asset inflation. The question, of course, with this data is if you were trading in the 70s and 80s, you know that people used to watch the M2 all the time. And there is some fear that at some point this is going to cause inflation, but certainly not in the short term. So to your point there, Alan, yep, it is helping risk assets for sure. Okay, and let's look at oil finally. So as I said, it's not surprising that based on that Saudi news, maybe some people take a little off the table here. Still seems like we want to fill the gap totally though. And we did have this inverse head and shoulders that broke in here. So a little bit of profit taking maybe after this huge move up. We'll take a look at the energy stocks, which has also been kind of on a tear recently, but a little bit of profit taking on crude, probably based on that Saudi news that we talked about. All right, let's take a look at what's going on with interest rates. So we broke out last week out of the 10-year. You were talking about that, Nina. Big pop up, coming back a little bit. But we have had what's called bear steepening in the yield curve, which has been given a little bit of push behind the banks. We'll see when we look at that. But taking a little bit off the table today, maybe. Our bond signal, thankfully triggered last Thursday, right in here. So now it's suggesting this is a TLT, this is a long bond principal. And there you go. I mean, we got to sell in there.
Now the Federal Reserve, they're going to meet, they have their 2-day meeting this week. And, you know, to the large extent, you know, we're not really expecting much. You know, the Federal Reserve is probably just going to reaffirm their near zero rates. But there are some traders out there that are saying that the Federal Reserve might down the road adopt some type of cap to control the yield curve for different sections, actually, I should say, for different sections of the yield curve, because we saw the 10-year, for instance, the yields, really popped. And they're thinking that around September, they might adopt some type of policy. And because some other central banks have done this, actually,
Japan.
Japan and
Yeah.
Australia.
Yeah, and you said something that there's some stuff you're hearing about a third mandate. Maybe you can tell us about that one.
Well, a lot of traders are saying that, the Federal Reserve has a dual mandate, which is full employment and stable prices. But a lot of them are saying that because, well, one reason is, President Trump really looks towards the markets, that the Federal Reserve right now is more heavily influenced, to also watch the markets. So they're saying that there, in fact, is more of a third mandate right now, which will include, equity prices as well. So they kind of have that third mandate now. I've read that in multiple places.
Yeah, that goes to the Fed put narrative for sure.
Mhm.
All right, let's look at the markets. The grind higher continues. We are at a place where profit taking could come in. You can see that's right about, what is that, 32-ish, 3200-ish. You can see that was the pullback in February. It was also the congestion area back at the beginning of the year. So we're right there. So maybe you could take a little off the table or not.
And if you did a year to date, Lee,
Let's do that.
just a year to date, like we're almost there.
Even. We're almost even.
Are we? It's like 0.5% or something. We're down like 0.5%. And when we take a look at the Dow, I think the Dow's about
Look at the Dow.
4% lower or something.
Let's see. Right now, yeah, you're right. You're right about -4%. Yep.
Mhm.
Yeah.
And
So, and of course, the Nasdaq is
right, we're 9% higher year to date. If you look
yeah,
year to date,
yeah. Let's take a look at that.
maybe 9.5. Let's see.
Come on, I got a type right here. There you go. Yeah, so we're up. Oh, that's 8%. So
Mhm.
yeah, about 9%. Yep. And again, you might want to watch the 10-day moving average here. So it's been a pretty good guide. We've only had one close below it really since the middle of April.
And they're saying that this is the strongest 50-day rally of all time.
Right.
So we took the elevator down and we took the elevator up.
You're up.
Usually it's not the elevator up.
That's right. It's usually the stairs up and the elevator down, but here we go. Okay, we have lots of questions on market breadth. So let us take a look at the breadth. All right, so let us start with the S&P 500. There is no divergence at all. So the market internals are pretty good on the S&P 500 there. Let's take a look at the NASDAQ breadth. So it's going in the right direction. You got to remember that there is generally a negative bias to the NASDAQ breadth because a lot of the companies can get listed more than other places. So you just got to look at the direction and very recent highs and lows. So it's going in the same direction. Let's take a look at the chart of the NDX, which is the NASDAQ 100, and then we'll take a look at the NASDAQ 100 breath. Yeah, so we're continuing to break out to this be an all-time high here, maybe. But yeah, I mean, don't do that. All right. So I think you can't fight the tape here. You know, if you're a real short-term trader, you could use the 10-day moving average. If you really wanted to tighten it up, you could put a stop under Friday's low, maybe. Let's see if the breadth in the NASDAQ 100 is doing what we think it should.
And last week, the NASDAQ was the weakest overall. It was only up 3.4%, while the S&P was up 4.9, and the Dow was up 6.8.
There is no divergence here either. The other interesting thing was we had a not a Zweig breadth thrust, but we had another Zweig 9 thrust on Friday, which typically has led to above average longer term returns. And let's just take a look at that. You can see we got another one. So this triggers, it's called the 9s, and there's actually the double 9s. I don't have the chart for the double 9s, but there is one. This is when 90% of the volume is in advancing versus declining stocks. So that is confirming this as well. It's confirming the breadth. So this Zweig thrust itself, we were very close to getting one at the beginning of this. We didn't. We just missed it by a tag. The classic thrust. This doesn't happen very often at all. It was very close coming off the bottom, but not exactly, given the way it's calculated. Okay. So you can't really argue with the market internals at the moment either. Now let us take a look and see what is moving. So we had a question, the housing index is doing well, so what's going on with the housing ETF? The housing, it depends on which one you look at, I guess, but the housing ETFs have been flying. This is the home builders.
Mm-hmm.
The other one that people look at is the ITB. I think they've been acting appropriately. So I think the ETFs are doing fine. They're pushing towards highs. We pointed these out when they broke out. Let's see what else is moving. We do have the continuation of a lot of momentum, and we have the continuation of the move into value. All right. You can see what is going on here. Energy is getting stronger and stronger, as you can see all the value stocks, industrials, financials, they're all getting into this improving quadrant, and you can see what is beginning to lag, the ones that were strong. Okay. You got healthcare and technology weakening a little bit, as well as the stuff that had done really well. So that is what's going on internally. And if you want to watch it, you can see what's going on.
And what time frame is this for, Lee?
This is the last 5 weeks.
Okay, the last 5 weeks. Interesting. Yeah. I like it. I do like it.
So you can see the rotation going on. Okay. The other thing is, there's a good question. Could the volume thrust at this level be a sign of exhaustion? Not historically, no. And we have a question. Everyone says we will have a correction. Are there any indications of that? Or, I mean, at some point, I wouldn't try to anticipate when it would be. I would say the corrections that you're getting are measured in hours recently. And remember, you can have a correction without the price going down, right? You can have a nice longer term chop near highs as a way to correct too. And that may be what's in the cards here. So what could derail the market? What could derail the market would be a strong indication that a second wave is coming, perhaps. There is something, you know, in some of the states that opened early, there is some recurrence of the virus, but apparently not enough to overburden the hospital system, which is the big fear. But certainly if it came roaring back, or if there's a mutation like the second wave in 1918, you know, then of course. But just looking at, nobody can predict that type of thing, I don't think. Just looking at the market internals and everything, I mean, we don't necessarily have to pull back in price. We could just correct by time.
We
All
have
right.
a question here about from Ron in Pennsylvania. How would the Fed, I just lost it. How would the Fed, I believe it was, there we
Cap
go.
interest
Cap
rates.
interest rates. Well, you know, there's been talk about this in the past. Federal Governor Brainerd was talking about, using these caps if rates go near zero next time there is a downturn. And she talked about this in November of last year. And I mean, they've got a lot of firepower out there. They could, buy treasuries, of course, different time frames, but they could even go out and use some of these new facilities that they've set up as well to buy different types of, municipal bonds, or, go do, let's say, corporates. They could consider that as well.
Yeah, so there's different ways they could do it. It just depends on where they want to put their buying and what part of the curve. All right, let's get let's just see what's moving today, and then we'll take a look at some of the charts. So we have lots of questions on the stocks. Yeah, a little bit of a pullback right now. All we're doing is testing the breakout level, though. It's been, you saw the rotation kind of out of technology a little bit. That's part of it. Maybe why it's coming back a little bit. There's also, I heard some stuff about people are maybe in the back of their mind worried a little bit about
China,
U.S.-China relations. Yeah.
Mm-hmm.
So that might be holding it back a little, but I mean, you can't, it's still Friday made a new high. So there you go. Now the question was, does it have a relatively, you want to look at the RSI on that? Well, I mean, it's up there. It got overbought, which is bull market behavior. Last set of pullbacks didn't even get to 50. So I think you're, the way you would trade this, I mean, if you think it's going to backtrack from the high, the reasonable place it could pull back to, the first would be 250, the 10-day, and then you would, that's because that's right also at the top of this range here. I can extend that, but it is not a bearish chart. So this is if it was going to pull back, this is maybe one area it could pull back to if they start worrying a little bit more about the now the UK, I think, came out today and are trying to isolate Huawei, right? So it's not just us in the US, for what it's worth. All right, let's take see what else is moving. I didn't want that one. I wanted Here we go. All right, so what is moving today? I'm gonna sort it by, there you go. All right, so to Nina's point earlier, the oil service stocks are moving because, as you said, Nina, they're opening up some of the taps, right? So the type of companies that service those companies are doing well. So these are the oil service holders. We had the breakout level in there for you, broke out Friday, and looks like the next stop might be the 200-day moving average. There's very minor resistance at 184, but I think the 200-day moving average is in the cards there. Let's take a look at what else is moving. I'm not going to make any jokes about making new highs with the pot stocks, but here we go. All right.
That's fiddly. I like it.
Yeah, we won't do that. We won't make any dad jokes on that. But there you go. These have been laggards for so long. Maybe they're finally. You got the 200-day looming up there, but you can set your risk pretty low on this one. All right. What else is moving here? Yeah, we had a question on mortgage REITs. We had pointed this one out last week. And it broke out. So this one is really moving. You know, it's the one that somebody was asking about. Let's see. What was the one? It was the, he had a different symbol. Oh, IVR. See if it's doing as well as this one. Well, I'm not, let's see. This one's a lot more thinly traded. But, you know.
What stocks are actually in
there? Yeah.
Yeah. I see a few of them. Do the research thing.
Yeah, it doesn't say there. I'll have to go to schwab.com.
Oh, it doesn't? Oh, okay. I can look it up on my end.
Yeah, we'll do it right now. Let's go to holdings. They have it? Where is it? So is this an individual company? I'm not familiar with this one.
Is that REM or you're
No,
looking
this
at
is the one the client wanted to look at, IVR.
IVR.
It's so this is a mortgage versus the ETF that holds a lot of them. I think that's it. So yeah, if you want more of a basket of them, you might want to look at here. Okie dokie. Somebody wants to look at NZL, which is New Zealand. Yeah, to the point, they did say they were COVID free.
That's right. You're right.
Yeah, it looks like going up to the highs on that one. Let's go back to our, let's take a look at just the major sectors too. Kind of interesting where the XLF stalled right at the 200-day.
And that was the financials. They were up the most last week. They were the biggest sector up 8%.
Yeah, so because they really moved when the 10-year really moved. It wouldn't surprise me if we breathe up here for a while, though. That's quite a move. And you're right at a pretty key resistance level. So, but nothing not to like there though. Under Friday's low, is certainly a place to set your risk. You can see not only is it under Friday's low, it matches the lows from last year. So that's a key level in the short term. We wouldn't want it, if this rally is going to continue, we wouldn't want to start filling this gap. So hopefully we can hold there. All right, see what else is moving. Airlines.
I guess jets, the airlines are, and the jets ETF, a lot of millennials are, they're the ones that are stuck at home, they're buying this. It's one of the most popular ETFs for young people to purchase.
Yeah, so the question is, do they have further to run, or is this a fear of missing out trade? It wouldn't surprise me if they pulled back. Where might they pull back to? Probably right there. But clearly, they broke out of the range that they were in. So I wonder if
No
Warren
one is,
Buffett is
yeah, no
kicking
one's,
himself.
yeah, no one's stepping in and selling though.
No.
There are no sellers, But American Airlines, I mean, they came out with some bad news, right? Just a lot of layoffs, and they're cutting salaries across the board, and also for their execs. So
Yeah, if you want one that has a lot of travel stocks, not just airlines, there's this ETF too, which broke out last week. It's a travel ETF. This one might go further because I think this might have some cruise lines in it too. Just see what's in there. We gotta go to Sharjah. It should show up in there. Sometimes it just doesn't on the research tool. Sometimes on the ETFs it'll show the holdings. So if you want to play that, nothing seems to be working for me today.
yeah, right. Let's see, American Airlines was up 77% last week.
Yeah.
Spirit Airlines was up 75, JetBlue was up 36, Delta Airlines was up 36, Hawaiian Holdings was up 34. Just huge levels. But now the traffic reports for the airports, they're due out, I think, this week. So
Yeah, it'd be interesting to see how it reacts there. We also have some life in the defense stocks. I don't know if you've been watching like Lockheed Martin. Let's take a look at the defense. Aerospace and defense has been on a tear too. First time we've gotten to overbought on the RSI since the crash, basically. That's bull market behavior. It could obviously consolidate around here. Again, it seems on a lot of these that are high flyers, you want to watch the gap that happened on Friday. So let's look at one more. So this is an aerospace one. We already looked at that. Let's look at the biotech that's popping up here. There's a couple different ones. So we had talked about this on Trader Chalk. It might be that these biotechs are flagging a little bit, which is some of them are actually at highs though. Yeah, so this one is flagging after its big breakout. Again, at this stage, they've had a big run, but just look for a breakout of the triangle one way or another to get the next move. I think even if we broke, I think really you could break this and still hold the breakout level. But generally, this is considered a bullish continuation pattern. So the path of least resistance is probably higher. And with that, Our time is up, Nina.
Thanks, Lee.
All right, I'll be back in about 15 minutes to go over the commodity channel index. Not that we say you should use one versus another, but we'll just tell you how some people have used that indicator. And then I know that you are coming back, right, Nina?
I will be on closing remarks with Senior Derivatives Team Manager Kevin Green, and we'll recap what's been going on in the markets, and we'll take a look at how stocks react around earnings and how that impacts option prices. So we'll do that, and we'll take a look at some stocks that are coming out with earnings this week. They're not big names, but you know, I thought we had some time and we could answer some options related questions.